Okay, good morning everybody. It's currently 4 a.m. 4:11 a.m. to be precise, and I love recording in the very early hours of the day or late at night because there's this peace and quiet, in the surrounding. So today I'm going to be explaining something very, very important, which is the next topic: indication. Right, so before I go into education, I just hope everybody understood the last video. It was more of an intro, and like I said, I struggled a little bit, excuse me, because I was trying to make sure people who just came into the trading space understood what I was trying to say, as well as those who are already there. I didn't want to make it extra basics, but I didn't also want to make it too advanced so everybody can grasp the concept I was trying to explain. Well, moving forward, I'm gonna make sure that everything is, on a normal level. So if you haven't studied the basics of trading, understanding candlesticks, understanding time frame, understanding some of these basic things that you need, you can go back to the other group, and those things are there, right? So in this video, I'm going to be explaining the steps the market takes in movement. So I'm going to write this out real quick before we proceed. Let's make this big. So for starters, when you look at the market, Forex, crypto, stocks, indices, options, and all of that, we observe that prices don't just move randomly, right? They move in three phases, and these are the three phases that I personally use in trading as well. And crazy stuff is, I am not bringing a new concept to your table or trying to teach you a new concept. This is something that has always been in the market, right? It's like somebody trying to redefine the laws of physics, like different laws of physics, like they're already there, right? These are things that already are in nature. Physics just elaborated it and made us see it clearly. That's what I'm trying to do, right? The market moves in three phases. Indication, which is the breakout in a certain direction. That's the first movement. I call it the indication. Then we have retracement, which I also call correction, right? Indication or breakout, retracement, correction, and then continuation, which is the actual push. Understanding these phases is essential for making smarter trading decisions, right? Because most people, they want price. Some people actually right now would think, okay, fine, market is currently here, market is retesting this area and all of that, or market is going to do this and all. Like, no, the market has rules like life. There are principles, right? So I'm going to write this here. We have the okay. We have the phases that price move, indication, retracement, oh come on, where did you go? Are you kidding me? Excuse me, guys. Okay. All right. So basically, these are the phases in market movement, right? So let's take, for example, what I taught in the previous lesson. This is actual push in the market, right? This is the actual push in the market. I'm going to label it so you guys understand it properly, right? So this point right here, this is the indication, right? And the crazy thing is this: for people who be like, oh, how does a trend start? We are talking about bullish trend. How do we know when a bullish trend is starting? How do we know when a bearish trend is starting? This is the starting point, right? We're not going to go into retracement or correction and continuation. We're going to talk about indication in this video, right? So what is indication? Let's start from there. You can call it breakout. Most people call it breakout. Now, indication is like the first sign that the market wants to move in a particular direction, right? It's like the market is announcing, yo, this is what I want to do. And one thing about indication is indication works with swings high or swing low. Okay, so let me mark this. For example, let me mark this as a resistance, or I generally call it PRZ. PRZ means price reversal zones. I don't like using this whole support and resistance terminology. It sounds I would say archaic or overused. People misuse that word a lot, right? So let's mark this area. Excuse me, guys. So let's just say this is like a range, consolidation, sideways movement, right? Let's put something like this, and then boom. So what we have here, over here, basically, let me mark all these areas. Okay, what we have here, basically, this right here, right? These areas that I'm marking currently. Hold on, guys, I will explain. All right. Okay. Now we're good. Now, when the market makes swing lows and swing high, what are swing lows? What are swing high? These are highest points in the market before price makes a retracement. Like I said, I don't want to use resistance and support, but I'm going to use it for this particular point. Swing high is like the highest point the price gets to in the market before it hits a major zone and retraces back, right? Those are the swing positions. Like over here we have a swing low. This was the lowest point price got to before it made an actual push. This is a swing high. Is an actual point that price got to before it made a retracement back down, right? I use the sideways movement because I'm not explaining in details about retracement and higher lows and all of that. We're not there yet. This particular lesson, I'm going to take it topic by topic until I explain every single thing, right? Trading is not as difficult as people make it seem, and also it's not as simple as some people make it look, right? Trading is about understanding and about application. Another thing is reaction. You don't predict the market, because I've heard people say multiple times, I'm predicting that price. No, that's actually a very wrong terminology. That's a wrong ideology, right? You don't predict the market, you react to what price is doing, right? You react, you don't predict. Predicting the market will tie you emotionally to how price is doing. Take for example, let's leave this. For example, let's say market is making moves like this, right? Ideally, price will come back down and then push back up, but you would not predict that market is going to come back here and push back up. Price could do something like this, right? That is why you react. When price gets to this area, you have to see some certain, let's say on lower time frame, you then see price make something like this, right? That's when you say, okay, fine, you have gotten a confirmation for you to take a buy from this area. You don't just take a buy because it's been doing higher highs and higher lows, higher highs, higher lows, higher highs. Obviously it's going to do a higher low. No, price can get to this point and decide that, yo, this is the point where I want to shift structure, and I need to do something like this, boom, and then come to this point and then do something like this, and then boom, market is going the opposite direction, and you'll be like, yo, what happened? I predicted a profit. Now you don't. You wait for reaction, you see how price reacts in this area, and then you take it. And then there are also times where after waiting for proper reaction, price still goes ahead to do what it wants to do. Then that's why That's where your risk management comes in, right? You're not going to be 100% correct. I never said, and I would never say I'm 100% correct. I take losses as well, right? But that's why we call it calculated risk. You calculate your risk. So back to this, right? This area are swing position, swing highs, swing lows, right? I made it rangy, right? Over here, we saw how price failed to create any form of lows. And I'm going to say this, write it down. Higher lows are what sustains a bullish market condition. Higher lows, let me write it. Oh, down is the and vice versa for bearish market condition. Say lower highs, they are what sustain a bearish market condition, right? Now let's go back to this that I used to teach in the previous video. You see how markets tend to create these zones and these structures, right? Low, high. Why is this a bullish market? Because it created a higher low, created a higher high, created a higher low. Now I'm saying it's a higher low that sustains a bullish market, because there are scenarios where you would see price doing this, right? You see price do something like this, and then you see this, and then you see something like this, and then you see this, and then you see something like this, and then you see this, and then you see something like this, and then you see this. Back in the day, we'll call this you have even forgotten the word, but it's like a triangle or something. Now what do we have here? Basically, we have the same highs, basically the same highs, but if you observe, the lows are getting higher. This low is higher than this low, this one is higher than this one, this one is higher than this one is higher than this is higher than this. So basically we are not in a bearish market condition because we are still creating higher lows. I think it's a bullish triangle or something like that. That's what we call it back in the day, like 2018, 2019, right? Then we used to draw something like this. We will draw it in this manner and probably connect it at some point and be like, when price breaks out of it, let's say something like this, and then we would expect price to just be playing around this area until eventually price breaks above and retests this zone, right? So basically what I'm saying in essence is higher lows are what sustains a bullish market structure, right? I have diverted a lot from what I'm supposed to explain, but I'm trying to make you understand the concept of what I am saying here. Indication, right? When market moves to a particular direction, showing us that it is out of what has been holding it down, right? So basically, let's say this area right here, this particular area is 2000, right? This area is 2000. This area has been holding price for as long as it had over here, and then price eventually breaks out to this area. Let's say this area is 4000, right? So basically what market has told you, that it has given you the indication that it is no longer trading below this area. This price can no longer hold it, and then is approaching the next zone. And one thing you need to understand is price moves in zone. A price does not move randomly, right? They have target area, they have targeted areas. There are big players in the market, and they tend to move this price within certain ranges, and then they wait for what I'll call retracement or correction of price back down before they move again. So basically an indication like I would say, excuse me guys, an indication is like the first sign that the market wants to move in a certain direction. Most people will wait for this and then they will pull out their Fibonacci. Some will put it here, some will put it here. Some will pull out their Fibonacci, take it to the highest point, and then wait for price to correct all the way back here before the push to target this area again, right? So basically, an indication which you should always look out for is the first sign the market wants to move. Now, like I've explained, price breaks a key area, swing high or a swing low, basically is vice versa for sales. Now this matters because traders who identify breakouts can prepare to enter the market with alignment to the direction, or with the direction that price intends to go, right? So basically, let's look at it on the chart. Let's go to the current market and observe how it looks, how it works. So over here, all right, we saw how market moved with gold here, creating lows, highs, higher low, and then this, at this point, this was the price reversal zone, this area right here. Now we can see how price gave an indication. This is the indication on the daily time frame. Do you take your trade off of that? No, but there are scenarios where you can take your trade off the indication. Say for example, you are an impulsive trader who trades breakouts, right? Basically, this was a zone that has been holding price. We saw how price reacted to this area. We saw how price reacted to this area. How price, basically, anytime market is below this area, it is selling massively and aggressively with big candles. So the minute price broke above this area, you could have scaled down. Say you were watching this on your 4-hour time frame over here, right? The risk would have been big. If you were watching this on your higher time frame, you would know that price reaction to this particular area is crazy and it always drops. The minute this candle broke above and closed above, this would have been your cue to take a trade. Remember guys, I'm not teaching you entries. I am trying to explain something. This is the indication that price is about to take off. Your stop loss below this area, like I said, the risk would have been big. And then your take profit, that's the crazy part about impulse trading. You have to look for a zone to take your profit, unlike waiting for correction, right? You could have taken your TP at this area in alignment with this zone. That would have been a 3.2x, but that's not what I'm teaching. What I'm teaching is indication. This was an indication that price wants to move up, right? Did it do that? Yes, it did. But then that's not where it ended. Price made a correction back down, right? We're not talking about correction, but after the indication came the retracement or correction, and then the reaction to this particular area. Now if you box this area, somebody would randomly say, oh, this is how market is moving. It's creating highs, higher low, higher high, higher low, higher high, eventually create a higher low and then push. No, market is not always going to move like that, right? What made this a valid higher low? Just looking at it on this time frame, you could see that when price came back to retest and reject this area that has been holding it, it created a low that was higher than the previous low. Remember, we have been creating higher lows, higher lows, higher low, right? This was the high, this was the higher low. It created another one. Now in this particular area, let's bug this out and see how price eventually moved from this point. Let's make this zone yellow, right? Let's go to the 4-hour time frame. Now if you observe, you will see that what price did right here, right? So basically, after it made its move, its push up to this point, price fell back down, creating a higher low, obviously higher than this. And then price tried to make another high, but it failed, right? But when it failed, it did not move lower. That's why I said what sustains a bullish market is the creation of higher lows. It didn't move lower. You can see that it created a low that is still higher than the previous one, right? Though this is not a valid higher low in terms of the overall bullish structure, but it still created a low that was higher, indicating that buyers are holding this position. We see how price fared here, and then eventually it created another higher low that is still higher than this one, right? This was the correction. After it gave the indication, it gave the correction, and it also gave another indication here and a correction that is going to be a continuation. It was at this point you could have easily taken your buys after, though I wouldn't advise you to take a buys on 4 hour, but this is a very good area to take your buy with stop loss below this area, and then now you have a clear target, this area where it made is an indication at some point. Basically, clean move, right? I'm going to teach you guys entries. This is just explaining price making indication. Now let's observe what market is currently doing, right? After market made its push, it got to this area. This is a rejection area, a price reversal zone. Now price has given us an indication, right? Breaking above the previous highs, higher high. So now it's created a new higher high. Now it's going to give a correction. How do we know the depth of market correction? We are going to learn about that. That's going to be retracement. In talking about retracement, there are different ways to know, right? You can use your Fibonacci tools. You can use your retracement. I call it a retracement ruler, what you use to measure the level of retracement. You can use your fair value gaps. You can use your breakout or order blocks. There are different ways to actually measure the level of retracement price is going to give, right? So basically that's all I want to explain in this video. Indication. You could go to your chart and look for different indication in the markets. Let's check other ones. Let's check BTC, right? This was widely recognized. So basically this was where the push started from. This area, this is where the overall push started from. So what market did is market shifted structure, right? Price has been trying to be bullish and all of that, and then what market did it shifted structure, and we can see how it has maintained highs, lows, lower highs, lower low, lower high, lower low, lower high, right? Now this lower high is established. Price has not broken it. Yes, we can see that price is spiking above it, but overall the market is holding this area right now. We can see multiple times market is trying to break above, but market is holding this area real well, right? So basically this, right? Now let's use the indication. This was the indication that price wants to drop. Same thing, indication, correction, continuation, right? Indication, correction. Basically what we're going to see next is a continuation down. That's how market makes its move. It's the same thing over and over and over. If you go back to your chart, you will see that price just makes its overall indication that, okay, fine, this is the direction I want to go, right? And then it makes a correction or a retracement, and then it starts continuation. Same thing, you can check other pairs, you can check currencies, you can check cryptocurrencies, literally every single thing, right? And remember, an indication is always a break of previous swing, be it a swing high or a swing low, right? If you observe this, is this an indication? No, this is not an indication, because no actual swing was broken, right? So let's say you point out this place. This is an indication. This is a correction. This is a continuation, right? Now this is a correction. There is no indication yet. Price has to break this swing highs, and then create its retracement, which is the correction before a continuation, right? If you know how this move on bigger picture, remember bigger picture, then you can know how to scale down to the lower time frame to get entries. Basically, that's it, right? I didn't trade today because obviously price is not giving me the kind of reaction that I want to this area. Price is still playing around, right? So I'm not really keen on taking any position yet. I'm still square. I'm just looking at the market, right? What I'm trying to explain is this: understand how the market move on the bigger picture. If you do, and you know that market move in 3 steps, that's it, 3 steps. Different people will call this area different things. Most people will draw this, they'll call this an order block. Price is going to come and induce this area, react to this other block, and it's the same thing, different terminologies, the same exact thing, right? The aim of this course is to simplify it for you, so you don't get confused when somebody is talking about breakout block or somebody is talking about liquidity grab. So you don't mess things up with your head and you think, oh, why is trading so difficult? Trading is not difficult. People are just using so many heavy words that make you be like, when will I eventually learn how to understand these words? Literally, most people like the theoretical aspect of trading, that they neglect that trading is actually more of practical, more of being on the field, being there, right? So this course is going to explain these things in simple terms for you to understand. Again, I see the market in 3 different phases, and this is just it. When I get that on a higher time frame, I scale down to my lower time frame, I look for my entries and I take them. How do I take my entries? Basically via structure. You see this right here. What you are going to get on lower time frame is something like this. You're going to get things like this. You're going to get something like this, and then it's going to shift, right? Basically it's going to shift. That's how it's going to start moving up. Boom. Now let me delete this so you see what I mean. You see how it moved? Basically creating lower highs, lower low, lower highs, lower low, lower highs, lower high, lower low, lower high, lower low, lower high, lower low, lower high, higher low, shift of structure. Boom. Very simple, nothing too complex. And if you observe, if you check, if you study your chart properly, you see that this is how the market moves. There is no other way. Let's check let's check BTC. Let's check when BTC shifted structure on the daily time frame. This is when BTC started rallying, right? Basically started making its rallying, created the first all-time highs here, and then started pushing, and eventually shifted structure here, came back down, created a lower high, created a lower low, shifted structure again, created this, and playing around. But when this major push started, let's use the line chart so you guys get to see it, right? This is how it works. Let's use this as the bigger picture. This you can see the shift down, created a lower high, created what looked like a higher low, right? This is higher, and then these lows created another high, higher than this, and then price again shifted, broke below this, and then this is where the whole bearish structure started. Literally, there is no magic. This is just how price move. When you look at it from a bigger picture, you will get less confused. You gain more understanding rather than confusing yourself with a lot of terminologies and all of that. Now if you look at the weekly time frame, I think it's cleaner here, right? Higher high, higher low, higher high, higher low, higher high, shift, boom, lower high, lower low, lower high, lower low, and then eventually. So that's basically it for indication, guys. I would love for you guys to go over to your chart markup. Now what I'm teaching is similar to what majority of the people teach, right? I'm not saying this is unique, and at the same time I'm not copying someone else's work. I'm just trying to simplify things for you. Again, the aim of this course is so that when I start calling trades and start giving breakdowns, you won't be asking questions, right? I'm taking our time, right? How many minutes have we gone recording this particular video? This is currently 4:42 a.m. This is 30 minutes into recording, 30 solid minutes. I could be sleeping, or I could be gaming, or I could be doing something else, right? But I'm recording for what? For free. You're not paying me. I'm doing it for free, so that when I start with the community, you don't get confused with, yo, what's this guy doing? That kind of stuff, right? So that's the aim of this video. And yes, I will try to break things down, simplify things as we progress, right? These are just the overall basics to how I trade, right? When we start tying it together, I'll call it probably a 2.0, a 3.0, confluence kind of thing. Confluence 3.0, confluence 2.0. You'll see where we tie everything together and eventually use them to execute trades, right? So that's basically all for this video. And try to identify this in the market, and you can probably send them to me to check if they are correct, or you can do your own research and all of that. So that's pretty much it for this video. I'll see you guys in the next video. Peace out, guys.